You are betting your $50,000 career on a $50 trade, and you don't even realize it. Every time you sneak a look at your trading charts during a meeting, you are playing career roulette. One bad glance, one distracted email, one angry boss, and that salary disappears. I spent 6 months trying to trade at market open while I was working a full-time job. I lost $850 and nearly lost my mind. The problem was not my trading strategy. The problem was not my discipline. The problem was that active trading, whilst employed, is a structural impossibility. In this video, I'm going to prove it to you with calculations. Then I'm going to hand you the exact pre-market routine that replaced my chaos with a trading system so simple it runs itself. Here is what we will cover. First, I will share an incompatibility audit that proves why day trading fails for employees. Second, you will learn a 30-minute morning checklist that automates your trades. And third, a quarantine protocol that stops you from giving back your trading profits. This is how you stop trading like a sacred gambler and start executing like a professional trader. If you have ever checked a trading chart during a Zoom meeting, you need to hear this. You probably believe your trading struggles come from a lack of discipline. That if you just focus harder, you could day trade successfully whilst working a 9-to-5 job. That is a lie. You are not failing because you are weak. You are failing because you are attempting a structural impossibility. Imagine a surgeon performing open heart surgery whilst driving a city bus during rush hour. A scalpel in one hand, steering wheel in the other, and every incision requires a swerve to avoid a pedestrian. Every time he checks the patient, he runs a red light. Is he a bad surgeon? No. Is he a bad driver? No. But the system is insane. Day trading requires continuous unbroken focus to manage risk. And your job requires continuous unbroken focus to keep your salary. When you try to do both, you are like that surgeon. You are performing surgery on your trading account while steering a bus full of work responsibilities. And every distraction is a red light that you just ran. You know that voice in your head during a work meeting? It sounds like this. My trade is open. Is it up or is it down? I should check. Just a quick peek. My boss is talking, but this could be important. What if it hit my stop loss? What if I need to move my take profit? Just one look. No one will notice. My phone is face down on my lap. Tilt it slightly, unlock it, open the app. Wait, my boss just looked at me. Lock the screen. Pretend I am taking notes. Okay. He looked away. Check again. Price moved against me. Do I close? No, wait. Let it breathe. Focus on the meeting. No, focus on the trade. Wait, what did my boss just ask me? That is not trading. That is self-torture. And here's the brutal truth. Your brain cannot multitask. It can only switch rapidly between two tasks, losing efficiency and accuracy with every switch. Here's what the professional trader's voice sounds like. I placed my trading order at 6:15 a.m. this morning. My stop loss is set. My target profit is set. There is nothing to check. If the trade triggers, my system handles it. If it does not trigger, no trade today. Either way, I am fully present in this meeting because my trading work is already done. Now, let me show you the calculations that prove why the first voice always loses. I call it the career roulette tax. Here's the calculation. If you earn, for example, $50,000 a year, divide that by 2,080 working hours. That equals $24 an hour. Let me walk you through that. There are roughly 52 weeks in a year. Multiply that 40 hours per week. That gives you 2,080 hours. So $50,000 divided by 2,080 equals $24 per hour. Every single hour you work is worth $24 to your employer. That is what they are paying you to deliver. Now, Every time you sneak a look at TradingView during a meeting to manage a $50 trade, you are risking that entire income stream. If your boss catches you 3 times checking your phone, your performance review suffers. And if your work quality drops because your brain is split between spreadsheets and trading candlesticks, then your promotion disappears. You are betting a $50,000 salary against the potential to catch a $50 trade. That is not ambition. That is career roulette. And the odds are worse than you think. Because even if your boss never catches you, your work suffers. Your brain leaks focus and your decisions slow down. Your creativity drops and you become the distracted employee without even realizing it. So we stop the bus, we stop trying to operate on the patient while it's driving. And here is the incompatibility audit. This is how you prove to yourself mathematically that day trading is banned from your life. Step 1. List the hours your job requires and divided attention. Be honest. For most, this is 8 a.m. to 5 p.m. minimum. Write down the actual hours, not the hours you wish you could escape. Step 2. List the hours that day trading requires chart monitoring. If you trade, for example, the US New York session, this is 1 p.m. to 9 p.m. GMT. If you trade the London session, this is 6 a.m. to 2 p.m. GMT. Write this down next to your job hours. Step 3. Compare the lists. If there is any overlap, day trading is banned. Even one overlapping hour means split attention, which means structural failure. And split attention in trading is not a 50% performance loss. It is closer to an 80% performance loss. Because reading price action correctly requires your full cognitive capacity. A distracted trader misses the subtle rejections, the volume clues, the momentum shifts that separate wins from losses. Here's why this matters. You cannot beat full-time professional traders and algorithms when your attention is fractured. Those professionals are not checking emails. They are not in meetings. They are not worried about their boss walking past their desk. They are hunting for your stop losses with 100% focus whilst you are operating at 20% capacity. Even a 10% focus leak is the difference between reading price action correctly and misreading it. This audit leaves you with only one viable option, a strategy that requires zero monitoring during work hours. Most traders fall into a trap here. They think, I will just check during lunch, or I can monitor on my phone between meetings. No, that is still day trading with extra steps. Your brain does not have an off switch. The moment you check that chart, your focus leaks into anxiety for the next 2 hours. Now that we have accepted day trading is off the table, what do we replace it with? We replace it with a specific routine that turned my trading around. The biggest myth in trading is that you need to be in the market to make money. The truth is actually the opposite. The more time you spend on charts, the more money you will likely lose. The professional trading approach for an employee is to operate like a sniper. One shot, one kill, and leave the area. And that starts with understanding when your brain actually works. Let me tell you the story that taught me this lesson. In late 2018, I thought I had hacked the system. My logic was simple. The market opens for the new week at midnight in my time zone. If I placed trades at midnight, I would catch the fresh moves before the Monday morning rush. I was using the daily chart, looking for pin bars and false breaks at major levels. My setup was solid. The problem? I was placing trades between midnight and 12:30 a.m. after a full day of work, feeling tired before going to sleep. For 6 months, I grinded. September 2018 to March 2019. I used the right strategy. I analyzed the right levels. I followed my rules on paper. But by 7th March 2019, I was down 17%. That was $850 on a $5,000 account. And here's what broke me. I was not losing because of the market. I was losing because of fatigue. You see, when I analyzed the exact same strategy during the weekend, my analysis was sharp. I could spot the pin bars, I could calculate the ATR, the average true range that measures volatility perfectly. I could identify the false breaks with clarity. But at midnight, on a Tuesday, my brain was dead. I would stare at the trading chart for 20 minutes and see nothing. Then I would force a trade anyway because I had already committed to the routine. I miscalculated stop losses, I misread the ATR, I confused support with resistance, but the strategy was not broken. My execution was. At midnight, my decision fatigue was at 100%. I had already burned through a full day of work, commuting, dinner, emails, and by the time I sat down to trade, I was running on fumes. My brain was a 30% battery trying to make 100% decisions. And the market punished me for it every single time. Here's what my midnight trading brain sounded like. It is 12:15 a.m. I'm exhausted, but this trading setup looks good. Wait, what is the ATR again? I think it was 80 pips. No, maybe 60. Whatever, I will just set my stop loss at 50 pips. That should be fine. That feels about right. I need to sleep. I will check it when I wake up. Just place the trade. Done. Finally, bed. That is not analysis. That is gambling with extra steps. And the consequences were brutal. I would wake up at 6 a.m. to find I had been stopped out by normal market noise because my 50 pip stop loss was too tight for an 80 pip ATR environment. Or worse, I would wake up to find I had forgotten to set a stop loss at all. Here's what my 6 a.m. brain sounds like now. Breakfast is ready, my brain is fresh, daily chart open, ATR is 73 pips, so my stop goes at 180 pips below the entry. Why? Because 1.5 times 73 equals 109.5, and I round up for safety. Position size calculation says 0.04 lots for a 1% risk. Let me verify. $5,000 account, 1% risk equals $50. Stop distance is 180 pips. So $50 divided by 1. So $50 divided by 110 pips equals $0.45 per pip. At 0.04 lots, each pip equals 0.4. Close enough. Entry order set, stop loss set, target set at 220 pips for 2 hours. Laptop closes at 6:30 a.m. Done. That one change, trading when my brain was fresh instead of drained, improved my execution instantly. And from that disaster, the 30-minute execution filter was born. Here's the exact system. Write this down. The 30-minute execution filter has 5 steps. Step 1, 6 a.m. to 6:15 a.m. is your analysis phase. Open the daily chart time frame only. Check the trend using the weekly moving average. Draw your 4 most relevant support levels, and for A+ setups like the pin bars, 3 white soldiers, or false bricks. But why only on the daily chart? Because lower time frames introduce noise that your pre-work brain does not have time to filter. The daily chart shows you the market's true intention without the distractions. Step 2, 6:15 a.m. to 6:25 a.m. is your execution phase. Set a pending order. Calculate your stop loss using the ATR, usually 0.8 to 2 times the current volatility. Why? Because this protects you from normal market breathing room whilst keeping you close enough to the action. For example, if today's ATR is 73 pips, your stop loss goes to, for example, 110 pips below your entry. This prevents you from getting stopped out by noise. Set your take profit at 2 times your stop loss distance. Use a calculator to ensure your risk is exactly 1%. Step 3, 6:25 a.m. to 6:30 a.m. is your shutdown phase. Log your planned trade in your trading journal. Write down the setup, the entry price, the stop loss price, and the target profit. Be specific. For example, pin bar support is not enough. Write pin bar rejection at 1.2650 daily support level ATR 73 pips, stop loss at 110 pips, target at 220 pips, risk at 1%. This forces your brain to commit to the decision. Close TradingView, close your broker platform, and shut down the laptop. Step 4, 6:31 a.m. until the next morning at 5:59 a.m. is quarantine, zero chat access. Your pending order execute if the price hits your level. If it does not, then no trade today. No monitoring, no meddling. But why? Because every time you check, you give your emotional brain a vote in a decision that was already made by your logical brain. And your emotional brain at 2 p.m., after 3 meetings and 2 coffees, is an idiot compared to your 6 a.m. brain. Step 5. Next day at 6 a.m. is your review. Check if the trade triggered. If it is still open, manage it according to your trading plan. If it closed, log the result. Profit or loss, write it down. Then repeat the cycle. But why wait till the next morning? Because checking throughout the day trains your brain to expect instant feedback, which creates the same anxiety loop that you are trying to escape. Now here's the objection I know you are thinking. This feels too slow. At this pace, I might only take 3 or 5 trades per month. How will I ever grow my account? I understand the emotional logic. More trades feel like more opportunities. But here's the mathematical reality. Let me show you the 2 scenarios. Scenario A, the anxious approach. 50 trades per month. You are checking charts at lunch, between meetings, during your commute. Your win rate is 35% because your focus is split and your stop losses are poorly placed. Your average win is $30 because you panic close early to lock in profit during work stress. Your average loss is $50 because you hold losers hoping they will turn around whilst you are in the meeting. Here's the calculation. 50 trades, 35% win rate means 17.5 wins. Let us round it to 18 wins. 18 wins times $30 equals $540 in total winnings. That leaves 32 losses. 32 losses times $50 equals $1,600 in total losses. $540 profit minus $1,600 in losses equals negative $1,060 loss for the month. Let's look at scenario B, the disciplined path. 5 trades per month. Your win rate is 55% because you only take A+ setups with your fresh 6 a.m. brain. At a strict 2R with $50 risk per trade, your wins are $100 and your losses are $50. Here's the calculation. 5 trades, 55% win rate means 2.75 wins. Let us round it to 3 wins. 3 wins times $100 equals $300 in total winnings. That leaves 2 losses. 2 losses times 50 equals $100 in total losses. $300 in profit minus $100 in losses equals a positive $200 gain for the month. Restraint is not the enemy of speed in trading. Restraint enables speed by preventing the blow-up that reset your account to 0. This is how Nicholas Davers made $2 million while touring as a professional dancer. He couldn't monitor stocks during market hours, so he developed a routine. Analyze via cables in the evening, mark levels, and send buy-stop orders to his broker. The next day, while he was performing on stage, his orders executed automatically. He did not need to be there. His preparation was so precise that the trades executed themselves. But here is the danger. You close the laptop at 6:30 a.m., but you still have your phone in your pocket. And that phone is a ticking time bomb. So now you have the 30-minute filter. But this routine will fail if you do not install the quarantine protocol I am about to show you next. First, if you want to know the specific reason you keep self-sabotaging, I built a free 3-minute diagnostic quiz called Why Am I Still Losing Money Trading? It does not just guess. It isolates your number 1 trading blind spot. Click the link in the description to get your foundational diagnosis today. You might have the perfect morning routine, but if you carry the market with you into your job, you will self-sabotage. The urge to check just to see how is it going is not curiosity. It is anxiety. And anxiety in trading leads to meddling. And meddling destroys the entire purpose of the 30-minute filter. Here is what most employed part-time traders do not understand. A pending order is not just a convenience feature. It is your clone. Think about it. At 6 a.m., your brain is sharp. You analyze with zero emotion, you identify the exact price where your setup becomes valid, and you calculate the stop loss. You calculate the target. You set the entry price. Then you walk away. At 11:30 a.m., whilst you are in a meeting presenting, for example, quarterly results, price hits your entry level. Your clone, the pending order that you placed 5 hours ago, executes the trade exactly as your fresh brain designed it. You did not miss anything. You are never required to be there. Your 6 a.m. brain made the decision. Your 11:30 a.m. brain just has to stay out of the way. Here's what the amateur thinks. What if the perfect setup triggers while I'm in a meeting? I need to be watching. I need to be ready. Maybe I can keep TradingView open on my phone, just one tab. I will put it on silent. I will keep it face down. What if it moves against me? What if I need to adjust my stop loss? What if news comes out? I need to be there. I cannot miss this. What if I place the order at the wrong price? I should double check. Just a quick glance. No one will notice. That is not trading. That is FOMO, the fear of missing out, dressed up as diligence. And here's what actually happens. You check at 11:30 a.m., the trade has not triggered yet. Price is, let's say, 10 pips away. You panic. You think, what if it does not reach my level? I will miss the move. So you move your entry order closer. Now price hits your new entry, but it was a false break. The original entry level you planned at 6 a.m. would have kept you safe. Your meddling just cost you $50. And here's what the professional trader knows. My 6 a.m. brain already made the decision. If the setup is valid at the price I defined, the order triggers. If it is not, no trade. I do not need to be there because there is nothing to decide. The decision was made hours ago by a better version of me. My only job now is to protect that decision by staying away. Your 6 a.m. brain is smarter than your 2 p.m. brain that has been in back-to-back meetings, answered 47 emails, and drank 3 coffees. Trust the clone. Here's the quarantine protocol. This is how you physically prevent yourself from sabotaging your trades. Step 1. At 6:31 a.m., immediately after placing your order, delete the trading app from your phone. Not hide it, delete it. Why? Because hiding the app still leaves it accessible. You will find it. Your anxious brain at 2 p.m. will hunt it down. Delete it. Deleting it creates a physical barrier. To check your trade, you need to re-download the app, log in, and wait for it to load. That 90-second delay is enough time for your logical brain to intervene and stop you. Step 2, use a website blocker on your work computer. Block TradingView, your broker, any forums from 7 a.m. to 6 p.m. Why? Because willpower is not a reliable system. Willpower depletes throughout the day. By 3 p.m., your willpower is gone. Step 3, trust your clone. The pending order executes or it does not. Either way, there is nothing for you to do. If the trade triggers, your system handles it. If it does not trigger, no trade today. Both outcomes are fine. But why do this? Because your 6 a.m. brain already decided this setup was worth the risk. If price does not reach your level, that means your setup was not valid. You did not miss anything. You just avoided a bad trade. If you cannot access the trade, you cannot sabotage the trade. And that is the entire point. Day trading with a job is not difficult. It is impossible. Day trading is one style, and it requires unemployment. Swing trading, on the other hand, the 30-minute filter, is how professionals with lives extract profit from the market. You are not quitting trading. You are quitting the self-torture that is day trading. Your job is not your obstacle. Your job is your advantage. It funds your account. It forces patience, and it keeps you away from the charts long enough for your trades to actually work. So you now have the system. The question is whether you will use it. I just gave you the 30-minute schedule, but showing up at 6 a.m. is useless if you do not know the specific trading signals to look for. So check out this video where I walk you through the exact part-time trading checklist that I use to find A+ setups. See you in that video.